Hey guys, welcome to our panel, the evolution of on-chain token launches to digital asset treasuries. We have an amazing collection of investors on this panel today. We've done everything from native token launches to investing in some of the really hot and happening digital asset treasuries on the market today. And I'd love to take a moment just to have everyone here introduce themselves and share a little bit about their work. Diana?
Hi everyone, I'm Diana Biggs. I'm a partner at 1KX. We are an early stage venture firm investing predominantly in token projects, although now also equity, but we have about 140 portfolio projects across the space, and many of those have launched tokens.
Hi, I'm Yago. I've been building in Bitcoin for the last 14 years. I started one of the first companies doing remittance and cross-border settlement called Epiphyte using BTC. Among other things, the Lightning Network was invented at my company. I started and helped found what became the largest DeFi platform for Bitcoin sovereign. And now I'm working on Bitcoin OS, which is, for the first time ever, we have the technology to allow Bitcoin to become a truly programmable, expressive, and infinitely scalable system.
Hi everybody, I'm Ryan Silva. I'm a partner and head of trading at Borderless. Borderless is a Web3 investment management company, and all views are my own.
Good caveat. Sean Pell here. I'm a general partner and head of digital assets at FinTech Collective. FinTech Collective is a global early stage venture capital firm based out of New York City. We're SEC regulated as an RIA. We manage a little under $1 billion of AUM. On the crypto side, the vast majority of what the fund does is early stage fintech, but by way of just trafficking in amazing early stage human capital, we were some of the earliest investors in what became known as DeFi. There was no term when we started investing in that in 2017 and 18. On the crypto side, we manage about $150 million of assets. Penchant for the liquid side of the book, so I've done everything from early stage token launches to the dApps that are all in vogue today.
Awesome, thanks so much. And my name is Tatiana Kaufman. I'm a GP at Moonwalker Capital. We're a liquid, actively traded fund. We have a crypto vehicle and a crypto equities vehicle as well, so we're familiar with both sides of the industry. I would love to kick this panel off by posing a question to the panel about what was maybe the first token launch you've been involved in or token investment, and pair that with what was the most successful or your favorite token launch or investment that you've been involved in. Would you like to take that one away?
Start with me?
Sure, go ahead.
Oh, perfect. I think before we even get into that, as just like context, like how did we even get here to be talking about digital asset treasury companies in the context of token launches? Being through multiple cycles in crypto, I go back to 2017. The canonical way of launching a token was through an ICO. Very little guardrails on how that was done. The management team would put together a brief deck, pitch a vision, go out and put a contract address, and people would send Ethereum out into the world and expect to get a token back. Surprising to no one, the vast majority of those ICOs pumped out of the gate, but since then, we're down 90% plus, and the lion's share of those projects have not actually done anything meaningful with that capital. So starting from that place, clearly not the right way. The pendulum had swung way too far towards projects. In the last 4 years, I would say we've kind of been in a regulatory apparatus that was super challenging, and it made it nearly impossible to do an ICO, to raise from the public. So what was the result? You wound up raising from private venture capitalists. They would invest, and the game was launch your token at a higher network value. Only a small amount of that circulating supply would float. So it wasn't really trading quite with a lot of trading volume. It wasn't a real price. And over time, the token price would go down. So neither way was like the right way of launching a tokens. I'm sure we'll go through
So
some examples.
I'm gonna take the other side of that. I think this is a story that we've heard told a million times. And just to be clear, I'm a Bitcoiner. I was aghast at everything I was seeing in the ICO space for most of the time that it was happening. But the story that we're told is that ICOs were this fest of scams that ultimately all went to zero and didn't produce any real value. But if you had taken, $1,000 and put a pro rata amount into every single ICO that was occurring in 2016, 2017, and previous to that, just like a monkey throwing darts, you would have outperformed every single asset class in the world with one exception, which is Bitcoin. It underperformed Bitcoin, but it outperformed the S&P, it outperformed gold, outperformed anything you can imagine. And the reason is that because you unleashed this free market, you did get a huge amount of absolute slop, or worse, scams. But you also got Ethereum and BNB and Solana and Cardano. And many of these have increased in value by tens or hundreds of thousands of percent. So to say that it was wrong, that was the wrong way to go about it. I think what we did is we took a free market and unleashed it upon an unsuspecting public who had never experienced a free market in their lives, had no immune system for these scams, and it still turned out great. So, I think the story is a lot more optimistic than what is usually told.
I would also double down on that, because what those ICOs and what these token launches were able to do in terms of the democratization of finance and access to innovation and investment is essentially what everyone else is trying to do now, or what the sort of mainstream firms in traditional finance are saying that they are now going to do, building on this technology, and it's actually already been done. And yes, there's a lot of lack of transparency, and it was a bit of a free-for-all, but that was also what was amazing, because you could have anyone participate in the ecosystem and take part in that. And that's actually what everyone wants to do now, but just, of course, in their controlled and regulated platforms, which does make sense and is the evolution, but it ultimately was out of that explosion, which was bigger than itself. I mean, Ethereum was an idea, like that was my first token launch that I witnessed. It was an idea that was bigger than itself, because it unlocked just that much incredible potential for innovation.
And I would almost say that now on the other side of that, we've seen all that Cambrian explosion of new ideas, new investments coming to market. And now we have the kind of other problem, which is that there's tens of thousands of coins launched every day on various token platforms, right? So now you're getting saturated the other way. So actually, Sean, I think that your statement is more true now than where it was in the ICO boom, right? Because just the sheer volume of coins that are being minted and traded, it dwarfs everything we've seen so far. And most of those coins, personal view, are going to zero, right? Like absolute zero.
So to be clear, to calibrate, I am not against ICOs. We've invested in a ton of ICOs. I am for a level playing field for investing in those ICOs. I am for having transparency, like a hindsight bias of saying, like, just throw monkey at a wall and put money into ICOs. You did fine. I think like we can always, as an industry, do better, and that's where I challenge. Like the ICO paradigm was probably not the best we could do. So where are we today, and what do I think the right outcome is for launching a token? And we could double click on it a fair amount, but like Hype is the canonical example of like, I think you could get further in bootstrapping your project before you actually launch the token and know what it does within the network, especially in a more regulatory friendly environment. I am highly supportive of your power users becoming large holders of your token. They have contributed to your ecosystem. They are what generate fees. We want them to stick around, to be active members of the community. And there's no better way than to make your early power users very rich. And that's exactly what Hyperliquid has done. And to me, that is the North Star for launching a token. But once again, product market fit first, before even thinking about the token. And then I think you marry that with like, I do think there is merit in having people invest money in an outcome outside of getting something for free. It's why a lot of these airdrops users have not stuck around. We could argue it's because lack of product market fit, but also they got the token for free. So prove you're active on the network, get access through a platform like CoinList or Echo, secure your allocation, buy at a lower price, also get rich that way. I think the consistent theme is you want users to get rich, whether they contribute money or time. Also allow investors to come in for strategic reasons. They shouldn't be the entire round. I think what we saw in the last 3 years is investors were the entirety of private funding rounds. Also not the right outcome. So I think the pendulum has swung too far both ways. I think we're calibrating on where we need to be and getting closer. I don't think we're fully there yet.
I think the market's going through a little bit of an interesting transition this past cycle. And coming back to what you mentioned about saturation of just having a lot of altcoins out there, and we've seen it a lot running both a crypto vehicle and an equities vehicle. This cycle is definitely different than the others because in the past, you're playing the altcoin game to try and outperform Bitcoin. And this past cycle, it's been incredibly difficult, either because the market's saturated or retail is exhausted of playing that game, or because Bitcoin has just been such a beast this cycle with institutional push that it's getting. And so what you're seeing is this transition of the beta on top of Bitcoin actually appearing in the equities markets rather than the crypto markets. And we're seeing the rise of people trying to get, new liquidity for their networks and new liquidity for their tokens by putting together crypto treasuries and taking them public. Is this a space that you guys are playing in? What kind of trends are you witnessing, and anything else you would care to share on that trend?
Yeah, I'll take that. This is an area of tremendous focus at Borderless right now. We have been very involved in a variety of digital asset treasury investments that span BTC, Ethereum, Solana, and others. I feel that what you mentioned about the institutionalization of our market more generally is really finding the ability to tap into public capital markets to be extremely valuable. So we're seeing many different participants try to mimic the MSTR playbook, so to speak. But beyond that, what we're really seeing is the global demand for these base assets. So there will be many more digital asset treasuries that come to market for specific altcoins. But I think that for certainly Bitcoin, it really is allowing institutional participation at the highest level. Because right now, initially it was, kind of crypto native participants participating, then it was equity participation. The next turning of this is going to be when the fixed income markets open up. And then that's going to open up just a tremendously large volume of participation into these types of vehicles. And ultimately what I think my view for the cycle is that it just extends the cycle. So I'll take a pause.
Yeah, it's interesting because on the one hand, I think we have a greater pool of liquidity to play with than we've ever had before. And the fixed income comment, I think, is incredibly interesting because, in DeFi, we have this concept of yield, and traditional investors haven't had access to that. And so now there's all types of conversations about packaging Ethereum into bonds, for example, and creating staking yield into an institutionalized product. And so I'm seeing positive movement like that on the one end, and then on the other end, this just feels like another ICO bubble in the making where we're just putting a wrapper on everything that doesn't have a use case and shoving it into a different pool of retail investors. Any thoughts?
I do find it interesting that on the panel before us, we had Franklin Templeton saying that value is moving on chain and going to stay there. And then we have the crypto native projects that are actually trying to find the access to capital off chain. And it's an exciting convergence, but I think fundamentally you need to think about what is the purpose of your token and why do we need these products and what are we trying to do with them? And that at the end of the day is sort of the question around any token launch is what does this token do? Why do we need it? What network are we building? What incentive mechanism does it play in that? For that to actually create a sustainable market and not be a surprise to people we don't know. There's also a opportunity for a lot more transparency, which we don't see in the crypto markets, and we certainly need more of it there as well. And so it's going to be interesting to see how that plays out as well.
Diana, what are your favorite tokens that actually have a use case? Putting you on the spot right
I don't think I can list a favorite token, but obviously there are tokens that you have to play a fundamental role in sustaining your network, or if maybe the role of that token is to be a meme, and that can also be a role. So there's so many different types, and I think what's really exciting is that the design space is so open. I think sometimes that we forget that this is really a completely emerging field, and how these networks will evolve and what the roles of these will be, because also often in order to create value from those, you need to have product market fit, and also you need to have some kind of revenue generation in these, and that cycle for it to happen. And also with the regulatory environment, we're just seeing that open up to really being able to understand where we can go, and is it time are these products ready to start charging?
I think the fact that the vast majority of tokens appear to have no point, while true, they're pointless and useless, is primarily not a problem of tokens or of crypto. It's an artifact of the fact that the crypto industry has effectively been illegal or sanctioned for the first 15 years of its existence. And especially under the Gensler SEC, but even before it, if you were able to demonstrate some kind of true value, right, that you're generating revenue, you're generating yield through a token, then you were criminal. And so the only thing that you could introduce were useless tokens. And so that is what the market produced. Effectively, what we did is by criminalizing all of crypto, the only people who were in crypto were criminals. Now, what we're seeing with Hype, what we're seeing with Pump, what we have been seeing with Injective and BNB, is that there's a very clear way to generate value for any kind of token. It's a financial asset. And if there's some kind of revenue stream, you can attach that revenue stream to the token. And what is looking more and more like the best way to do that is that revenue stream consumes that token. And so what that does is it creates effectively equity-like instruments which exist in the crypto space and are generating real products with real users. And I think we're only at the very, very beginning of that. And so the fact that we've opened up the aperture for allowing real utility and people to actually generate real value means that very, very quickly the market has responded. And we, within the last year, since this aperture has opened up, we've seen the 500 million Pump.Fun, which it's not a product that I'm going to use, or probably anyone here, but it's generating revenue. Hype is generating revenue. BNB has been doing the same thing through all kinds of regulatory arbitrage shenanigans for a long time. And I think that that's the future of the space outside of Bitcoin.
Interesting. So are we just taking these companies public, or these networks public? Like when we're putting Sol and BNB and some of these other things into a treasury, is the point just to give access to liquidity to a different type of market, or is there a point greater than that?
No, I don't think this is about giving access at all. For that, we already have ETFs. The point of treasury companies is effectively financial packaging. So, I'm less convinced than a lot of other people that we're going to see the kind of success that we've seen for BTC treasury companies with other kinds of assets, because BTC, first of all, has been outperforming and will continue to outperform all of these other assets. And second, because the size scope of that market for BTC is just so much greater and needs to be packaged. So if I'm a retiree and I want to be able to take my $1 million in retirement funds and generate a 10% fixed income, it's very, very hard to do that without taking on significant junk bond risk today. But I can do it with very, very low risk by buying bonds which are backed by BTC. And so what Saylor and the subsequent companies are doing is they're basically taking BTC and repackaging it for different type of risk and return appetites or portfolios that people are looking for. And that has been the key innovation here.
Yeah, but I also think that that's what is enabling a broader universe of market participants. So there previously, even in the ETF side, like you mentioned, there are some equity investors that can't invest in ETFs, but they can invest in a single asset, in an equity that's an operating company that's going to perform arguably better than the ETF, given the ability to, generate staking yield on 100% of your stack, given the ability to have this capital market arbitrage in terms of your balance sheet. But what you just mentioned again as well, you have now credit market participants, you have other sophisticated market participants that did not have the ability to access Bitcoin before, but they can buy a convertible bond. And that is like instantaneous value, like unlock in terms of like the total addressable market. It's massive. So,
but they also don't necessarily want naked Bitcoin, right? So
yes, yeah. But just as the ETFs, right? Bitcoin ETFs, super successful. There's just as many people. I'd say maybe a third to half, maybe a third of all of that CME volume. That's perhaps just pure basis trading, right? So like the ETFs came out that allowed a certain market participant, like TradFi market neutral type trades, to come into the market, right? Similarly, you have Bitcoin treasury companies and other digital asset treasury companies that are coming to market with convertible bonds. There's volatility arbitrage, but it also gives institutional investors access points that they didn't have before. So I think it absolutely widens. You talked about the aperture. I think it's wide open.
I echo that. I think it continues to widen the audience, and I will say this will ebb and flow. Clearly, we are in like the velocity and pace of play right now for these digital asset treasury companies is I haven't seen this frenzy since the ICO craze in 2017, but it's institutionally driven, which makes it even crazier. I think we're in like inning 2 to 3, so I don't expect it to slow down. I am more sanguine about digital asset treasury companies on assets outside of Bitcoin for the same reasons you are, which is the ability to drive token per share, so SOL per share, given it's a proof of stake asset. You could generate yield just by staking, by driving more MEV, by doing the basis trade sometimes. So the toolbox of what's available to drive yield on the underlying asset is much more interesting to me on proof of stake assets. I love what Saylor has pioneered, but I think we're going to see some pretty innovative structures. They do introduce risks, like we were part of the Athena deal recently. That is locked Athena. There is a chance with locked Athena or a locked token that gets contributed in kind that these DATs trade at a discount to NAV. But that means there's going to be a whole set of M&A. So the banker is going to make a shit ton of money if no one else, because there's going to be M&A opportunities in a year when these things trade at a discount to NAV. There'll be opportunities for event-driven hedge funds that come into the space to buy up some of these things at a discount and do something interesting. So I think we're in the early innings. But once again, I think this is going to ebb and flow. I don't think it necessarily has to cannibalize on-chain activity. I think both are synergistic to each other. So if you think about the end of last year, it was the meme coin. It's not that long ago. It's like less than 8 months where like the entirety of the focus was on Solana, and the Trump meme coin did $35 billion in one day, 10% of the NASDAQ on chain, on a permissionless blockchain. We can't discount that. Like today, trading volume is down for sure. The meme coin phenomenon has come down, and all the activities in the public markets. But it's better for all of us that we have both these conduits, and we have on-chain participants, and a packaging for retail and institutional investors. So I think it's all accretive in my book, and I just think it's going to ebb and flow between the on-chain markets, which right now seem kind of dead, but all it takes is just like 1 or 2 great launches for that to have a resurgence.
So we know that the bankers and the lawyers are always going to make money on these things, on the way up, on the way down. For us investors in the room, what are some of the risks that we should be looking out for? One common answer to this that I hear is the 2027-28 convertible wall that's being piled up by some of these treasury companies. What are some of the other risks, particularly due to complex structuring and leverage that's being created in the system that you guys are witnessing?
Yeah, I'll just say like markets are very cyclical, right? We have seen, just like what happened in the last cycle, there was too much leverage that was added in at the highs, right? That was very bad leverage. What we're eventually going to see in this cycle is too much leverage at the highs. That's going to perhaps it runs into 2027. That's when that wall of maturities come that needs to be refinanced, and maybe that doesn't happen. But we're not seeing that warning sign. Like what are the risks? The risks are excessive leverage. By our estimation, we're not seeing excessive euphoria in markets, not in the market microstructure, not in derivatives markets, not in the underlying base asset. There continues to be real strong hand buying in the market from global market participants that is only accelerating, and it's also accelerating on the sovereign level too. So there will be a time, maybe that's in 2027, where we start to see this kind of peak out. But right now, that's not the greatest risk. And maybe I'll make a bold statement on this panel here, where I think that the biggest risk right now is perhaps in the right tail and not the left tail for Bitcoin's price.
What does that mean?
That means that there is a finite supply of Bitcoin and a very growing global appetite, and there could be a greater price dispersion to the right tail of the price distribution than the left tail of the price distribution.
Diana?
I would say that in addition to the lawyers and the bankers making money on the token launch side, the market makers and the exchanges are making an awful lot of money and might be the only ones benefiting sometimes, not even the early investors. So I think that we have seen over the past few months, and obviously since the beginning of token launches, there are games being played around circulating supply, around who's holding what, around what's actually driving price action. That when you don't have necessary disclosures, or you have disclosures that's a form that you fill in yourself, or when you have misaligned incentives from others who are going to be profiting off the launches, that it's very hard to know what information is real. And so I think that is actually one benefit of going to the public markets. But we have had blowups in the past, right? We have had ETFs or ETP products for tokens, then the token has gone to zero, which has obviously repercussions in with a stock exchange or a traditional market that is already feeling like they're taking a little bit of risk on a new asset class, and then something like that blows up. It's just something to bear in mind and be wary of.
I think there's a lot of fundamental risk in what we colloquially call the crypto space outside of the Bitcoin ecosystem. I think the biggest opportunity is in the Bitcoin ecosystem. It's mostly untapped, it's much larger, and it's got network effects that far supersede anything else. And on the other hand, within what we call crypto or altcoins, we have a huge number of structural problems. It's a market that has, from its inception, underperformed Bitcoin, and people are starting to notice. So it was fine for it to underperform, but the fact that people are noticing is a real problem. The market structure, as a result, has become increasingly nihilistic. And because it's increasingly nihilistic, we're seeing market makers, exchanges, but all kinds of market participants, VCs, not the ones on stage now, but the VCs just generally in the industry have been becoming increasingly short-termist. The founders, many of them, are becoming increasingly short-termist, and so a lot of the way that the market is being structured right now is to try and take advantage of what people see as an upcoming bull market to try and get out with as much booty as they possibly can, and I think that they might succeed. And I think that's the biggest risk in the token space, is that we're going to see more and more of that. And you only need even a minority, but even if 20% of the market is doing that, the inability to differentiate between those projects, tokens, and players in the market who are doing it and those who are not makes everything into a lemon.
And I think what's also challenging there is that some of the founders who are incredible technologists and building fantastic products don't know anything about capital markets or understand the sort of offers that they're being given by some other market participants or what's really happening there. And so you can actually have the ones that understand financial engineering and are gearing themselves up to that, maybe on the other side of that with less of a product. And I think that's something where we try to work closely with our founders to help them understand what's happening in these markets, and we need more of those. And I think there are some moves in the market itself. We saw, was it CoinWatch producing transparency tools for market makers, because I think people do want to align incentives and to bring more transparency and to help these founders understand how the markets work as well.
Yeah.
Guys, thank you so much. This was such an engaging panel. I wish we had more time because I know each one of you is such a wealth of knowledge. We're all going to be around after the panel, so please come and hang out with us and say hi. Thanks for having us.